Afternoon again, everybody. Dwayne here from DRFX Forex Swing Trading. Taking a look at the situation on the Euro US dollar once again. Here we see that the market has given us this strong bear candle below the uptrend line as a signal that we're going to actually continue the sharp reversal back inside of the consolidation and head towards the support boundary. All of this is what we call a false breakout from consolidation and takes place when a signal was given to break out in one direction is taken out by a reversal candle that takes us back inside of the consolidation. This all started when the market attempted to break up bullish with this large candle here. But as you know from price action theory, this candle is one of those that you avoid. Reason being, they either lead to sideways movement or sharp reversals, such as the one taking place right now. So this is why many traders would have anticipated that we were not going to be continuing to move higher. Traders who were unaware of this, unfortunately, would have been affected by this. But now that you're seeing an opportunity to take advantage of this reversal, you can make up for that for any losses that you may have incurred at this area here. So this is a false breakout. This is a very typical example of a false breakout reversal situation. And now that the candle has been given, now the signal has been given by the daily chart, the next thing to do is to look on the 4-hour chart to determine if there are any entry setups for us to take advantage of this expected movement. Now, as you can see here, the daily candle signal took place with the break of this counter trend line setup on the 4-hour chart. So this was the setup that led to the signal that we're now seeing on the daily chart. So many traders have different ways of taking of trading these situations. One way that which is the way that I recommend is for people to place their stop loss above this area here and then enter at this area. Now, in terms of your stop loss, this stop loss will be very high, will be very large, because if you were to enter the trade right now at 11:20 to this area here, you're talking about over 200 pips in stop loss, in potential losses. So that is a very large stop loss for most retail traders. The one that I recommend is to use a stop loss of 120 pips. So what that would mean is that with a stop loss at this area here above the high, using a stop loss of 120 pips, we're going to need a pullback to this price area here. 113.35, so that would be 12.15. That would be the entry area, the entry price that we'd want the market to pull back to take us in the trade and to give us a reasonable amount of leeway in terms of market movement before we actually see the market pull back, resume the breakout bearish. So 120 pips is an ideal amount that I think is appropriate for this type of trade and for daily charts and to use when we have a daily chart signal and we're going to enter using the 4-hour chart. So with a 120 pip stop loss, our target will be 200 pips from that entry area, and the target would be 200 pips from this entry of 12.15, so talking about 10.15, and that would be hit at this area here, not very far from where we are, but we're gonna need a pullback and then a U-turn to continue bearish to hit our target. So that is one way to trade it. If the market does not pull back towards this area here, then we're gonna need the market to give us another 4-hour candlestick formation signal at this area here. Now, since the market is moving pretty quickly, the type of signal that you're gonna need to trade, or that needs to appear, has to be in sync with that expectation of a fast movement based on the candles on the daily chart. So again, from the manual, you will see that there are different types of 4-hour entry signals that you should expect and that you should trade depending on the expected movement of the daily chart. If the daily chart is expected to move pretty quickly, then there are certain types of 4-hour signals that you should trade. If the market is expected to move normally, then there are another set of 4-hour setups and signals that you should expect and trade. So what we see here has to be in sync with that rule. So that is something that I'm going to wait on to see what appears at this area here, and hopefully there will be a possibility to take advantage of it. I must point out that right now I'm in a trade on another pair, and generally when I have one pair open, I usually trade one pair at a time when it comes to swing trading. So what I'll do is if I see the appropriate signal at this area here, and I check that other trade, and if it's closed, then I'm gonna trade this one. So the key with this one is to wait until we see an appropriate signal that is in sync with the expectation of how fast the market is gonna move. So these are the two possibilities: entry with 120 pip stop loss, and the expectation that the market is gonna pull back, and a 200 pip target to take advantage of this entry here. Otherwise, we're gonna have to wait to see if the market gives us a follow-up setup, if it doesn't pull back to this area, and gives us a signal where we can take advantage of the movement to this area here, and which should be able to give us between 100 and 200 pips in profit. So this example is another situation in which we need to be aware of the types of signals that the market should give us. There are times when we see signals that look strong enough to trade, but if it is not in sync with what we expect based on what is happening on the larger time frame, then that trade might actually lead to a reversal and take us out. So that is one of the pitfalls and one of the traps of the currency market. Sometimes these signals can be very attractive and very strong, but if they're not in sync with what you should expect based on what is happening on the larger time frame, then it's not going to work out. So that is something to bear in mind. So just to recap, overall situation on this pair: false breakout reversal taking place, heading back inside of the consolidation, and we expect this market to move very quickly based on the speed of these candles and based on the reversal that started it and based on what we're seeing right now. This is actually similar to a trade that we made last year on the Swiss franc, where we had a similar reversal taking place back inside of a much larger pennant setup. This took place, this was either the 4th or the 5th trade as part of the swing trading methodology, and it was a similar setup where I believe instead of entering, this was the 5th trade that gave us 76 pips. This was an occasion in which the entry actually took place using a follow-up 4-hour chart signal. So I waited until the market, the daily chart, closed with the signal, and then entered on the 4-hour chart a few days later. So these are some of the previous trades that took place before that trade that I'm going to show you in a while. This was the Aussie US dollar trade, and this is a trade where we took advantage of a similar false breakout that's now taking place on the euro, where the market initially broke out again with a large candle that you can see was taken out once again. So another example of how large candles are generally risky to trade, and if you can take advantage of the reversal that takes place after those candles appear, then you can profit from them, as I did here. So false breakouts, very profitable to trade. The key is to spot them, identify the context in which they're taking place, and know the appropriate signal and setups to trade.